So I think Bitcoin goes up 100-fold in value from here, 100 times. That 5% over the next 20 years is now 500% of your portfolio. There's where you start managing risk, okay? Because if information changes, you change your portfolio allocation. But don't forget that the 5% is insurance against all this other 95% that you have over here that really is risky, okay? Because if the banking system does fail, I promise you this 95% over here, damn, this is like you can see the forest fire coming across the valley, and you're supposed to prepare for this, guys. It's that simple. If your eyes are not wide open to this reality, well, then you shouldn't be managing risk. And all we have to do is listen to people like, well, you know, the talking heads within the IMF or whatever that just are paid not to tell the truth to people. So just get your insurance, guys. The only wrong allocation to Bitcoin is
Even though Bitcoin is called a risk asset, for the past few weeks, we've seen Bitcoin taking its place as a safe haven not against inflation but against banking crisis and sudden wipeouts that have been happening. People everywhere ran to the banks and withdrew their money to buy it and protect their wealth, making Bitcoin jump to the 28,000 price level. But even though Bitcoin has been consolidating ever since, many experts are still more bullish than ever, some calling it 20x or even 100x from here. One of them is Greg Foss. Greg spent over 30 years of his life in financial markets, and he now says this is the best opportunity he has ever seen. In this video, he will explain why he believes that, how math says we're going 100x from here, and what you need to do now to position yourself for massive profits. So pay close attention until the end. This Greg Foss interview is highly valuable. First, let's have a quick look at the number on the US and macro.
I just run the numbers on the USA, which is the strongest fiat in the world. There's no question, but I like to say it's the best looking horse at the glue factory because all fiats are debasing. So this just happens to be the one that has it will survive the longest. Okay, so if you take the USA and you look at their debt situation, it is mathematically impossible for them to grow out of their debt. The interest expense on the debt is going to grow faster than the economy under any scenario. And that means that the debt is growing organically, regardless of whether a government comes in that adds to the current deficit with deficit spending. Okay, so you know that printing money is the solution because otherwise it blows up. So QE infinity is grade 11 math, which means as long as they can keep this going, the debt will, so USA has $31 trillion of debt, funded debt, and another 170 trillion, it's so mind-boggling, of unfunded obligations like Social Security. But let's just look at the funded portion, that's $31 trillion. 2 years ago, the interest expense on the debt was about 300 billion. What is 5%? Because that's overnight rates right now. 5% of 31 trillion. That assumes all the debt rolls over at a 5% rate. That's $1.5 trillion annually that you have to pay on interest expense. Now, the USA doesn't take in enough money after you subtract out military spending and Social Security. So here's the thing. So what happens is hopefully that credit balloon expands because there's enough demand for US Treasury refunding. But it'll crowd out other demand for credit. So high yield bonds are going to be in really big trouble because high yield already is full of zombie companies that can barely meet their interest expense. Now, the USA cannot meet their interest expense, but it can print money. These guys can't print their own money. If they can't roll over their debt, boom. And what does that do to bank balance sheets, Bill? Because then high yield spreads change to loan spreads, and loan spreads get marked to market in a trading portfolio, but not on a bank's book, unless there is a default event, and then they have to take it to the provisions for loan losses. And you know how the accounting works. It's just a gimmick. So I'm not bullish. In fact, I'm very bearish on the credit system. However, there is a way out, because I don't want to be the last house standing in Hiroshima. I think there's a number of ways the US can address this. We could talk about that. But the reality is, as long as you print more money, you can keep the Ponzi scheme going. You just have to protect your net worth with assets that will appreciate in value when a money printer goes burr.
And this is why Greg believes Bitcoin to be the solution.
But having spent my entire life in fixed income, I found Bitcoin in 2016, and I immediately thought of it as the solution to the fiat Ponzi that took me all the way back to my first job at Royal Bank of Canada, where I said, this fiat Ponzi thing is ridiculous. If the banks are regularly insolvent, how come they still have high credit ratings? Well, because they are too big to fail. And if they're too big to fail, they get bailed out by a country. And what can a country do? It can print money, which means the value of that money is debasing over time. So I'm a hard asset aficionado, if you want to call it right now, of which I do like gold, I do like commodities, but I really love Bitcoin, because here's where it comes. Bitcoin I think of as credit default swap insurance on a basket of fiats, not just the US dollar, all fiats in the world, and there's no counterparty risk, Bill. This is the beautiful thing. This is my insurance policy, and I don't have to worry if the insurance company is going to be able to pay me back. I'm a Bitcoin maximalist when it comes to digital assets, but I don't have all my money in Bitcoin.
Yep.
Bitcoin is the only digital asset that solves the fiat Ponzi for two reasons. Firstly, it's the only true decentralized platform. There's no CEO. And secondly, and most importantly, it's the only one with a fixed definable supply. Okay. So not to point fingers at other, Ethereum, for example, but if you ask Vitalik, who is essentially the CEO, what the supply of Ethereum is, his answer is, well, it's difficult. I don't want, well, it's difficult.
Right.
I want to know that there's
Right.
only 21 million coins.
Why does Greg say Bitcoin is a risk-off asset?
Here's the craziest thing. I've always viewed Bitcoin as a risk-off asset, because what is insurance? Insurance is a long volatility product. What is long volatility? It's things that will go up in price when the world is melting down. Okay, what happens with stock prices when VIX spikes? Stock prices go down.
Yeah.
If you're long something like insurance, in theory, it should go up in value when risk increases. It hasn't been that way historically because everyone's traded Bitcoin as a risk-on asset. I think they're wrong. I think Bitcoin's insurance. Therefore, I think it should always have traded as a risk-off asset, which is to say when things get more risky, the value of Bitcoin should go up. Is this why it's played out though, Bill? Now, come on. In the last 3 months or, 3 weeks, since the beginning of the year, it's been because of bank concerns, largely people taking their money and seeing that the credit or the fiat Ponzi, which the transfer mechanism is commercial banks, those are risky.
Yep.
They're looking for alternatives. So it's a combination of both, but never forget the insurance, which I view Bitcoin as, and I can value Bitcoin using credit default swaps.
And please pay attention now when Greg explains the real math behind the 100x Bitcoin price prediction.
And I can value Bitcoin using credit default swaps on sovereign debt. And by the way, Bitcoin is stupid cheap insurance. So I like that valuation methodology. People can agree with it or not if they do. But most importantly, I think over time. Now, here's the crazy thing. I'm an Ivy League guy, so I'm allowed to say this. You're probably an Ivy League guy too, but I didn't.
No, not even close.
Okay, well, here's the crazy thing. So I'm an Ivy League guy. I can say this. Most algos that are programmed on Wall Street are programmed by 25-year-old Ivy League cucks that have just come out of school, and they look backwards and program asset correlation prices looking backwards rather than looking forwards, as they should. The difference is when that model breaks and people realize, oh my God, Bitcoin's actually insurance and it's got gamma. And we could get so technical about it. I've just never seen a better asymmetric trade opportunity in my entire career. And that's why I do own a portion of my assets in Bitcoin. That's it. You can have hard assets, and then there's roving bands of people searching for food, and there's absolute dysfunction in the whole world. Now, some of the Bitcoin maxis out there say stuff like this: the lion does not care when it eats the antelope. Okay, this is natural progression, and you have to live by this. I think there's something somewhere in between, but I also say, damn, this is like, you can see the forest fire coming across the valley, and you're supposed to prepare for this, guys. It's that simple. If your eyes are not wide open to this reality, well, then you shouldn't be managing risk. And all we have to do is listen to people like, well, you know, the talking heads within the IMF or whatever, that just are paid not to tell the truth to people. So just get your insurance, guys. The only wrong allocation to Bitcoin is zero. Okay. Zero. If you're short it, then you're really a knucklehead, but I can't help you there. You might be a day trader, whatever, but long-term, over a period of 20 years, Bitcoin has a value of over $2 million per Bitcoin in today's dollars. That's my analysis. Send your hate mail to Bill. I've done the work. I'm a credit guy. I'm telling you, this is the best form of credit insurance I have ever seen, and no one's done the work on it. So that's where we are. So I like to start them at anything greater than zero is good. Let's try and get you to 5%. Okay. At any point in time. And you don't do it all in one shot. Why don't you take how much you would need to invest to get to 5% and divide that purchase up over the next 20 weeks. Okay. So every single week you buy the same amount of dollars worth of Bitcoin. And if the price has gone higher, you're getting less Bitcoin. But if the price has gone lower, you're getting more Bitcoin. So that at the end of that 20 weeks, you have a 5% exposure. So stick with me here. 5% exposure. It's like these people forget what happens to the other 95%. And they're just zoomed in now on this 5% exposure because it's a new thing, right? And they're like, oh my God, it's gone up and down. I'm like, guys, this is for the next 20 years. You want this 5% exposure. So I think Bitcoin goes up 100-fold in value from here, 100 times. That 5% over the next 20 years is now 500% of your portfolio. There's where you start managing risk, okay? Because if information changes, you change your portfolio allocation. But don't forget that the 5% is insurance against all this other 95% that you have over here that really is risky, okay? Because if the banking system does fail, I promise you this 95% over here is exposed to tremendous amounts of risk. You just might be comfortable because you've always grown up having your money in a bank, for example. So that's portfolio risk analysis, risk. And by the way, I will never tell anybody to put 100% of their net worth in anything. That's not the way I manage risk. So there are out there Bitcoin maxis that say you're a knucklehead for owning anything besides Bitcoin and 3 months of fiat to live. And I'm like, well, you don't live in a house? Yeah, I do, but I rent. Well, I don't rent my house. I actually own my house, and I include that as a lifestyle choice. So, Bill, you talk to high net worth individuals. These are the people that understand how to manage risk implicitly. They've done it because they've built businesses or they've taken risk and have been rewarded. This is so important to get everybody off zero. And if the number, so personally, what's my number? Well, my number started at about 25%, and it's substantially higher than that now. But it's still not 100. This is what I have to tell, because it doesn't have to be. When you have an asymmetric opportunity like Bitcoin, you don't have to be all in.
What is your strategy for Bitcoin? Are you buying every week or just waiting for the bottom to jump in? Let us know in the comments below. And if you want to see more daily crypto content like this, please leave a like and subscribe. Thanks.